Dr. Jim Gaines is a chief economist at the Texas Real Estate Center at Texas A&M University and focuses on housing and land development issues. Dr. Gaines spent 16 years with KPMG and Arthur Andersen. He also served as president of Rice Center for 5 years, where he directed the real estate, urban economics, and demographic research programs. Dr. Gaines started his professional career as an assistant professor of finance and real estate at Kent State University, and later was an associate professor of real estate and finance at the University of South Carolina, where he taught undergraduate and graduate level real estate courses. Dr. Gaines has more than 35 years of experience in a broad array of professional activities, primarily in real estate research and education, urban economics, land use analysis, and development and project risk assessment. Dr. Gaines has worked extensively with major corporations, developers, investors, financial institutions, and government agencies across the country. In addition to his consulting background, Dr. Gaines has been an active real estate educator not only at the university level, but also for professional programs in real estate appraisal, GRI, CCIM, and other training courses. Dr. Gaines authored numerous professional papers, articles, monographs, and technical reports covering a wide array of real estate topics and analysis. Thank you, Dr. Gaines, for being here. And we are especially excited. Now? Yes, I can hear you now.
I had to log out and log back in.
Perfect. That was perfect. And I just introduced you. So you missed your
introduction. I heard the last part.
Okay.
It rambles on. That's what PR people are for.
All right. Well, we really appreciate you being here, and we're glad to catch you before you retire. So we know that you do a great job of not only interpreting the economics, but also making it very interesting and entertaining. So welcome, Dr. Gaines.
You're more than welcome. I don't know about the entertaining part, because I got to tell you, I've obviously done several of these kind of Zoom presentations, and I don't see anybody. When I'm in the middle of the presentation, all I can see is my slides. I'm talking to my computer. So it's kind of like Star Trek. The computer doesn't talk back to me though. So it's kind of disturbing. Anyway, let me see if I can bring this up. And you guys, can everybody see the slide?
Yes.
I can see 3 people, and I'm seeing nodding heads. All right, because now I have to turn you guys off so that I can see the slides. Okay, good morning, everybody, and thank you very much for having me. I appreciate it very much. I've always enjoyed doing Four Rivers area. You guys are the in-betweeners. So of course I'm going to refer a little bit to Austin. I'm going to refer a little bit to San Antonio, and then I do have some specific data on the Four Rivers market area as defined by the area of the Board of Realtors, the Association of Realtors. So with that in mind, we'll get started. And like all of the presentations here I've done lately, you got to start with the overall economy because of what's going on with the pandemic and so forth. And we're officially in a recession. It started the first quarter of this year, which is somewhat ironic, quite frankly, because January, February, and the first half of March really started out very strong. They started out strong in the economy. They started out strong in the housing market, and everything was going along just famously, if you will, and it was going along just great. But by middle of March, of course, we had the shutdowns getting started. Everything kind of went down, and then April and May were really bad. So the first quarter was down about 5%. Second quarter went down 31.4%. And that's the worst that's ever been recorded as long as we've been keeping these GDP numbers, which goes back into the 20s, 30s for a quarter. Now, we had that kind of fall off in the 1930s in the Great Depression, but not in one quarter. It took a while to get there. Now, the irony is, of course, is that the third quarter of this year, we went up 33.1%, which is absolutely the best on record. And incidentally, these are annualized quarterly changes. It's not really the quarter, year over year, one quarter of last year to this quarter this year. This is the rate of change during the quarter on an annual, if you continued for an annual basis. So the arithmetic is a little bit different. So let me put it that way. But here's the problem. If you go down 30%, you got to come back about 50 to 60% just to break even because of the way the rule of changes, the arithmetic of changes work. So the 33.1% increase didn't help us all. It helped, but it didn't bring us back to where we were before. We're still probably 6 months away from that. The fourth quarter estimates, I put a purple bar out there at the end. I mean, this is my best guess, 4 to 6%. It's a real crapshoot. To tell you the truth, I've got on here that fourth quarter estimates range from 2% to 12%. Quite frankly, the range is broader than that. I've seen it from -2% to +15, if you really want to know the truth. But those were the extreme kind of projections. And let me also preface a lot of what I'm telling you right now, and I'm sure our lenders who were the sponsors here this morning, if they have their own economics department or reading economic report, they're going to tell you real quick. There ain't an economist in the world that really knows what the heck is going on or how to predict it. We don't know. We've never had this kind of episode before. We've never had the kind of pandemic, the mandatory shutdown for months, the mandatory restrictions on what businesses can do, how much business they can do, particularly the personal services businesses, the businesses that require personal interaction, hotels, restaurants, gyms, bars, beauty salons, you name it, anything that revolves around personal interaction or personal services has been dramatically affected and cut back. So anyway, this is what it looks like. I'm going to talk a little bit. Here's what I'm talking about. We haven't recovered at the national level. We're still over about 10 million jobs short of where we were in February. I mean, you can see the orange line out there. This is an economy that fell off a cliff. We went from February down to that bottom point of 130 million people working was in April. So it only took March and April. And really, it was the month of April statistically that we lost about 20 million jobs. And we've only regained plus or minus about half of those jobs. So we're still woefully short in bringing back the employment levels to where we were. There's still, I know I'm going to show you a slide here in a second, which is the weekly claims, but there's still about 20 million people that are claiming some kind of insurance, either the regular unemployment insurance or one of two types of pandemic-related emergency uninsurance. Here's what you've seen this graph. Probably you're getting tired of seeing it. We're getting tired of talking about it. You want to know the truth? There've been over 70 million people in the cumulative effect. About 40%, really approaching 45% of the whole workforce that have applied for unemployment somewhere between the time of March 15th, roughly, and today. It's been wild. You see the little stubby black bars over to the left? That's what normal, quote unquote, looks like. Unemployment claims running between 200, 250,000 a week on the total U.S. Employment base. Last week, or the last week we have the data for, was close to 853,000, which is more than 3 times normal rate of reporting or claiming unemployment insurance. And of course, as all of you know, all of the extra benefits, the extra $600 a week and so forth, ran out several months ago, back in July, end of July. And that's what all of the debate is now on the next stimulus package, the so-called stimulus package from Congress that they've played politics with here for the last 3 months and haven't done anything. And I was just reading the news here this morning. They're still bickering back and forth on what to do and how to do it. But that and it really wasn't a stimulus. I say so-called stimulus. That was a survival package. That package, the extra money was going to people to help them survive, and the PPP program to help small businesses survive. There wasn't any stimulus to it. It was really survival. What's it going to take to get us out of all of this? Well, you know it as well as I do. First and foremost, we got to get the virus and the pandemic under control. And I'll admit to you, I don't know exactly what under control means, but we've got to get the number of cases, we've got to get particularly hospitalizations and deaths down at a rate that can be, I guess, acceptable, if you will, or at least not a concern or a major concern. From everything I've read by the health experts, we're never going to completely cure this. This is not one of these things that if we have the vaccine, which is coming out today and going to start being distributed tomorrow, or actually applied, it's being distributed today, inoculations being starting tomorrow, it's not going to get cured, but maybe we can get it where it's treatable. If you get it, it's preventable, or at least to some extent, percentage-wise, preventable, and so forth. Once we can do all that, then we're going to start re-employing all these 20 million people that lost their jobs, the 10 million that are still out of work. We're going to increase overall demand for everything. Retail sales actually have come back to pre-pandemic levels, but total personal consumption, which is total spending by not only, mainly by people, we're still not spending money the way that we were before. That's still 5-6% below where it was before. And that's the number that it represents about 70% of that GDP number. And it's got to get back up in there. Yeah, it won't happen until we get the virus under control and people get back and start going to restaurants and start getting their haircuts and so forth on a more regular basis. And we get business and corporate America back spending money. They're not spending the money as much as possible. Report this week, I read corporate America is sitting on about $4 trillion. That's with a T, $4 trillion of cash, and they don't know what to do with it. They're not willing yet to really spend it on a lot of expansion and plant and equipment and so forth, which means more jobs. And they're just basically sitting on it. That's one reason we're going to see more mergers, acquisitions, and so on. One thing that corporate America knows how to do, if they can't spend it on other things, they go buy other companies. So they're going to do that. Global trade is really up, except it's up on imports for the U.S. So we have a negative trade balance. Exports around the world are going up very much. Inflation is not much of a problem yet. Wages and salaries and incomes have not gone up percentage-wise as much as other things, and particularly housing. That I'll come back and talk about that in a bit. Interest rates, I guess the best news for you, even to our sponsors. It was interesting listening about the refis versus the purchase, and you are in unusual circumstance there in the Four Rivers area if the purchase is almost twice as much as the refis, because nationally it's the other way around. But interest rates are low. They're at historical low levels and are expected to stay there. I'll show you some more about that. Taxes and spending by government going up. It's going to continue to go up. And I'm just warning you right now, for the next 2, 3, 4 years, you're going to start seeing slowly more and higher taxes, because the government, local and state and county and cities are all in a bit of a bind. Now, the only good news on that front is that the units that require property taxes, especially since the residential property tax base is not only holding up, it's going up rapidly, but the commercial real estate is not doing as well as the residential. And that's a bigger part, or a big part of the property tax base. And that's what you're going to need to work on. Debt, of course, is going to be a long-term killer. 3, 4, 5 years from now, we're going to have to start figuring out how to repay a bunch of this debt that we're going into right now. The national debt went up about $3 or $4 trillion this year alone. and that was a remarkable amount. Here's what I'm talking about, though, getting the virus under control. You can tell from the blue line and the orange line on a national level, we aren't under control yet. In fact, just the opposite. It's going into even worse circumstances, more people reporting new cases and so forth. Read a report this morning that the estimate is that the new cases being reported are still undercounting the reality because those are based on test results, not on actual results. And as you know, not everybody's getting tested. So it's really kind of touchy. Let me take off of the national. That's just sort of what's going on nationally. Texas is doing better, even though we got hit with the double whammy. As most of you know, back in January, actually late December of last year, Russia and Saudi Arabia went into a price war on oil. We started a dramatic decline on the price of oil. So the first whammy that hit Texas was the energy market had a dramatic fall off. And then in March, of course, we got the second whammy of the pandemic, which has been even more severe, and it exacerbated the energy decline too by reducing the worldwide demand for oil. It's going to be very uneven and so forth. And here's what Texas looked like. We look very much like the US. You can see we weren't doing too bad back in March, April, and May. Relatively speaking, Texas, of course, avoided. That was when New York was the big center of attention and so forth, and New England area. And then, as you well know, in May and June, we opened up our economy earlier than a lot of other states because the economy was suffering so much. Well, that did lead to an increased level of cases. Then we started a decline in July and August, and then had a little blip up when we tried to do some more things. And then, of course, school opened and colleges and universities reopened. And then we're on our I guess our second wave. We get semantics in here of whether it's an extension of the first wave or another wave or whatever. But anyway, the rate went back up again. It does show some evidence of trying to decline here lately, the far end of that blue line coming down. And the good news is the orange line coming down as well. So we'll have to see how that keeps moving. But right now, we're still getting really hard hit with the pandemic. And everybody is expecting it to still continue to be kind of bad for the next month or two because of the holidays. We're going through the post Thanksgiving, and now we're entering the Christmas season, and then we're going to hit the post-Christmas season, and that's going to affect. So it's going to be into later January before we really start seeing whether or not we're making a whole lot of progress. Here's the energy market. Rig count is just below 150 rigs. You can see it. Everything fell off the cliff back in January. The price, the orange line there. It has rebounded. It was, I just looked it up just before we got on the air here. It was at $47 and some change here this morning. As you know, you can track this on an hourly basis, and it'll drive you nuts if you do. But it's been hovering here for the last week or so in the $40 to $45 barrel range. For the last couple of months, it's been hovering closer to the $40 level. Most of the experts, quote unquote experts, and anybody who tells you there's an expert in predicting energy prices is either a fool or a liar. But most of the experts think that the price probably within the next year or so will probably get back up into the 50s. But that's assuming that worldwide demand picks back up once we get the virus under control. The dominoes have to flow and drop. Fall over in a regular basis. Here's Texas weekly unemployment claims, similar to the U.S. I'm not going to belabor the point. In October, we gained 118,000 jobs. November numbers are coming out here this week. We'll find out. November should be pretty good. We're making inroads to reclaim and get back some of those jobs we lost. Unemployment claims. The continuing claims for unemployment is still around the 500,000 range. So won't get back up into to break even on that for a while. Here's what it looks like graphically. Like I said, we don't have the November numbers yet. The state numbers are always, it range about 3 weeks coming out later than the national numbers. For those of you who like to track these kinds of things, that's the reason I don't have the November number here for you today. But we're down about 4%. We've actually rebounded better than the national level. We're up closer to coming back to where we were. We're all using February as sort of the benchmark. Can we at least get back up to where we were in February? Forget any kind of growth. Can we just get back to where we started sometime soon? And I suspect that there on that far right-hand side on that orange line, the November number will be again back up again. We had a little bit of a downturn in September, but I think the October number will come back up a little bit. But it's not going to be back up to break even for a while. Here's something we put together at the Real Estate Center, just for people who are interested in looking around the state of who's doing what and how well and so forth. And the people in Waco really love us because it basically shows that Waco is almost 100% recovered. They didn't get hit as hard with the virus, didn't get hit as hard with job losses. And so they have been able to come back quicker. Texarkana, ironically, there in Tyler. But you can see Austin Round Rock is at about 97% recover. San Antonio down there at about 95.6, call it 96%, about the statewide average of 96%. Still about 4% off some of the others. Houston, of course, is on further down the list. That's because the double whammy hit Houston a lot harder than it hit Austin or Dallas or San Antonio. Austin, Dallas particularly are not particularly energy related at all. My favorite saying is that J.R. Ewing, notwithstanding, Dallas is not an oil and gas town, despite what the rest of the world thinks about it because of that TV show. But Houston, and then you can see at the bottom of the list, Corpus and Odessa and Midland, a lot further down the stack, mainly because of the energy market declines there, as well as the pandemic, more energy than pandemic related. Here's what unemployment rates have looked like around the state. I'm giving you the May number because that was the worst. The May was the bottom, if you will, or the worst that we hit. October of a year ago, we were running in Austin 2.6% unemployment, in San Antonio 3%. I mean, those are extremely low unemployment numbers. Normally, those numbers are probably in the fives, somewhere in the 5% range, 4.5% to 5.5%, something like that. And you can see by this time, October here of 20, Austin is back at least to 5% and San Antonio 6.3. Those are still a little higher than what we've been used to the last several years, but not excessive, and especially when compared to how the unemployment rate dipped there in May. Here's what the daily trend looks like in the Austin area. This is from the New York Times, and you can see that Austin has had a slight increase back up again here lately. You see every once in a while the bars have the individual daily spikes, and those you kind of get away from. The blue line there's the 7-day moving average, which kind of stabilizes it a little bit to be able to see what trends look like. And you can see back in June and July had the sharp increase in caseloads again as the economy was opened up and businesses went back into play. But we recovered from it pretty well and even got through the September-October period in Austin until here lately. We came back up, and then a lot of this probably reflects a little bit of the holiday season, the schools and so forth. San Antonio looks very similar to that. You can see that there's the individual daily spikes that occur from time to time. Nobody's really sure exactly why those happen, whether it's a matter of the testing process or whatever. And of course, that's going to move that 7-day average when you get one of those spikes. So even the peaks and valleys on the blue line there are a little bit suspect because of especially the enormity of the differential, the difference there in some of those spikes. But nevertheless, you can see a general trend up in the month of October. I mean, in the month of November on into early December. Again, some of that maybe the Thanksgiving effect, the traveling effect, and so forth. But we see, and it's a kind of a mixed bag. Here's what's going on with employment in the two major metropolitan areas that sort of anchor the north and south of the Four Rivers area. Actually, Austin is going to do quite well, we think, for the year. Being down 1% in this year, in the year of 2020, it's not too bad. Normally, that would be cause for a lot of concern. You can see in 2018, 2019, growth at nearly 4% a year. Austin has just been taking off, and Austin is still expected to continue that. I mean, hey, you got Elon Musk moving to the area, and you got Tesla coming in, and Oracle coming in. I mean, Austin is going to be just fine. Some of the numbers and the statistics haven't even shown up yet for all of these things that are going on. Year to date, it's down about, on a year over year basis, down about 2.7%. That was similar to what I showed you on the chart there, the 94, 95, 6% recovery. So but we think by the end of the year, it'll look something like about down 1%. San Antonio, maybe a little bit more. And San Antonio, don't forget, is much, much, much heavier into leisure and hospitality industry because of the tourism trade, the restaurants, the hotels, the bars, etc., personal services kind of things, conventions, air travel, and tourism, which is down a lot more. Year over year, it's down a little less than 5%, but that leisure and hospitality down about 14%. We're expecting for the year, for the total employment, because other sectors of the San Antonio economy are trying to come back: financial activities, professional business services, other services, even manufacturing to some slight degree. Construction is up. So we're seeing some other things. So on an annual basis, when we look at it, probably be down about 2%. And you can see that San Antonio, while it has been in a significant growth mode, the rate of increase has not been anywhere near as much what Austin is. But don't ever compare yourself to Austin. Austin has been out of sight. Nobody compares to Austin. Almost at a national level. There are only maybe a couple of three other metropolitan areas in the whole United States that compare to Austin's rate of increase and rate of growth and job growth and so on. Well, let's turn our attention a little bit then to the housing market. The housing market, I'm sure as all of you are aware, has been the driving primary economic driver here for the last 6, 7, 8 months. It's been one of the only industries in the United States that actually has been not only growing during the pandemic, but actually booming. It's been extraordinary what has been going on. The primary reason for that is, you got it, the low interest rates. I mean, we've got the 30-year fixed mortgage rate, that black line up there, and that's the Freddie Mac 30-year fixed mortgage rate that they report on a weekly basis. And then I'm reporting it here on monthly. So the numbers will look a little bit different than what you're probably reading on a day-to-day, week-to-week basis. But it's close to 2 3/4% in round numbers, even for the month of November. So, and December is going to look just as good or better. I mean, for those of us who are over 50, thinking of getting a mortgage at under 5 was great. Under 4 was unbelievable, and under 3 just defies gravity. So, I mean, it's just ungodly what it is. The federal funds rate, the green line, that's the rate that you read about in the press all the time about the Federal Open Market Committee. You can see it runs, it's just above the zero line. Officially, the effective rate is 0.25 because the range is from 0 to 0.5. So we don't show it right at, but it's effectively 0. The 10-year Treasury, though, gets your attention. And that's a rate that's used for a lot of different things. One of the reasons I've got it on here is because it is the rate most directly tied to the fixed mortgage rate. Generally, if you add about 160, 170 basis points, 1.6, 1.7, maybe 1.8% to the 10-year treasury rate, it equals the 30-year fixed mortgage rate. And that 10-year treasury is down historically low. Remember I told you the corporate America sitting on a bunch of money? Well, so is corporate America, corporate entities and financial investment entities around the world. And right now, as bad as it is in the US, we're still the most stable economy in the world. We're still the least risky economy in the world. So we've got a lot of demand for our treasuries and so forth. This is one reason the federal government has been able to borrow $4 trillion this year to fund all of the activities that the government, and not to mention all of the local market zones. Anyway, the 10-year treasury is very important. It is trying to come back up to, it's been hovering really at about 0.6, 0.7 for the last 6 months or so, really most of the year. And it is trying to get back up to that 1% level, which is still historically low. The long-term 10-year treasury has generally been somewhere between 3.5 to 4.4. So, you know, you can tell it's way the heck down in terms of where it is. Home market, here's some of the good news. Here's some of the good news I'm going to give you. The home builders, the construction part of new construction is just going bananas. That blue line up there hitting a housing market index reading of 90, which just means that 90% of the builders that the National Association of Home Builders and Wells Fargo interviewed said that the market was good. And they actually asked about 8, 9 questions. This is the composite of those different 8, 9 subgroups. Foot traffic, expected sales, expected revenues, new starts expected, and so on. There's about 7, 8 different categories. And this is the culmination of all that. 90 is a historical high. I mean, you can see back there over the far left, back in 2005, which was a record year for home construction, it was at the 70 level. So when you're up to 90% of the home builders around the country are telling you things are not only good, they're great, and they expect it to stay there for a while, then that's really good. And then what you can see is the housing starts. The orange line has followed suit with that general feeling of goodness by the home builders. I don't know how else to describe that, guys. You know, you can see that, you know, new home construction is now well over 1 million units, and it was running well under 1 million units. I mean, when you're down to 400,000 units back as we were in 2010, 11, that's nothing. You're just not building. And we still, even at building 1 million units or 1,000,001, 1,000,002 units a year is still not enough, really, to balance our housing market relative to the demand. And that's especially true in Texas. Speaking of which, my lead in, let's talk about Texas and the Four Rivers housing market and see how we're doing. On an index basis, you can see that Texas is taking off. As good as the US housing market is, the Texas housing market's even better. We still have a lot of people in Texas. We still have people moving to Texas. We still have businesses moving to Texas. With Texas at about 96% recovered on an employment basis, while that's not, we wish that it was much better than that. That's by relative terms compared to other states and what other economies are doing around the United States and around the world. It's extremely, extremely good. And our home sales have been reflecting that. We've got people, almost 90% of the people, you know, still have their jobs, still working. A good many of us, like a lot of us who are here on this call, working from home. Of course, in your industry, you can kind of work from home. In the real estate industry, you can kind of work from home anyway, except for our sponsors. I guess maybe they need to get into the office and take loan apps. But now, even that, everything has changed. even the loan application, the closings, the closing process, and all of the other it can be accomplished online. You don't actually have to be physically together or go to a title company and sit down at a table and sign the papers. It can all be done remote online notarization, the RON, which Texas is a state that allows that. So everything has changed in terms of who's doing what and how they're doing it, the processes, the procedures. And a lot of that is going to carry on over even when the pandemic is over. I suspect that a lot of these processes, the virtual tours, the online virtual tours of houses and so forth, dealing with customers, both buyers and sellers, online, by phone, and so forth, is going to continue for some time. Here's what Texas looks like. Our purple bar, this is based on what the Real Estate Center, we were looking for sales to increase about 3.5% this year and prices to go up 4%. I can tell you, we're already off year to date. I mean, even just through November, this is through November. We do have the November numbers. Sales are up over 7% and home prices are up somewhere close to the 7% mark as well. It's been a remarkable year. Another record year. You can see the green bars ever since 2012. Each bar is higher than the bar prior to it. We recovered. We matched our previous peak of 2006 in 2015. Now it took 9 years. And that's something you ought to know. It took almost 10 years, a decade, just to get back to the prior peak record. But remember, in 2006, it was real easy to get a home loan in 2006. Ask any of the lenders what their lending practices are today versus then, and it's a world of difference. But you can see we've gone way on up above that. We're going to keep going up. The housing market's doing real well. Here's what's affecting the housing market. First of all, is limited inventory. I'm not telling you anything you don't know. I'm sure all of you can give me anecdotal stories about homes where you've had multiple offers and so forth. And your biggest challenge perhaps today is to go out and find existing homes where the homeowner wants to sell and is willing to sell. So, and especially in key price ranges, the key price range of around 200 to 300, or it varies a little bit from area to area, maybe 2 to 350, but somewhere in there. New construction is still not adding to that supply quickly enough, and that means higher prices, which means affordability is an issue, particularly relative to income. Here's the issue on affordability. Home prices are going up much faster than incomes. And ultimately, you run out of space to be able to afford a home based on your income. You're either forced to rent or so forth. We have a historically low interest rates are going to continue. I suspect that's going to be the case for almost all of 2021. There's only some extreme scenarios that we've been able to put together that would indicate interest rates going up dramatically. Now, that would they go up a little bit? Would it go back up to 3% or maybe even 3.25%, something like that? That's indeed possible. Maybe 3 1/8 is more realistic if it's going to go up, but that's probably going to even be the latter part of 2021, not in the first part. The ease of mortgage financing, some of the lenders are getting a little nervous. We do know that the delinquency rates have picked up. We do know that there's probably going to be some foreclosures coming up in 2021 at a much, much higher rate than what we've had the last several years, especially nationally, but even in Texas, even in the Austin and San Antonio and Four Rivers areas, the I-35 corridor, if you will, that is going to happen. The Mortgage Bankers Association puts out an index called the Mortgage Credit Availability Index, and it is showing that there's a trend nationally among the mortgage lenders requiring higher FICO scores, really wanting higher down payments and so forth. Now, the counterbalance of that is the Fannie Mae, Freddie Mac, FHA, and VA are all making loans or trying to make the loans easier and make homeownership. So there's a little bit of a dichotomy there. The overlay underwriting criteria in some instances is getting to be a little bit greater than what it's been in the past. The ease of credit has always been the key issue. Just how easy is it to get a loan? How easy is it to qualify for that loan on your credentials? And that is getting maybe a little bit tougher. General concerns about the economy and so forth, that is playing into the fears, if you will, of buyers and sellers. Sellers, maybe if they're in their house and have been there for a while and so on, and they're nervous about their job or whatever, maybe they're nervous about selling, so they don't want to list and sell their home. Buyers are nervous about buying because they're not sure how long or how secure their job is. On the other hand, if they're real secure about their job, they're in the market and they're buying and they're looking to go. Here's what single family building permits, it's still not enough. We're up 17% for home building this year. And look, we're beginning to approach where we got to in 2005 and 2006 in terms of home construction, which was the record. And we're 15 years out from that. And I give you comparison back to the 80s. It took 16 years to come back from that. We're 15 years out from where our previous peak was. We're just now approaching, and it's taken a pandemic and under 3% mortgage interest rates to get us back up to that, even close to that level, if you will. Here's Austin. We're looking for Austin to be a strong market. Sales will be up. This is probably going to prove to be conservative. I'm going to suspect that Austin is going to be up a great deal more than this by the end of the year. This was our original projection of 1.5. I think year to date, Austin home sales are up close to about 8 or 9%. So that green line, that's actually the year to date number, I think. So it's going to be another record-setting year, and home prices, as you well know, Austin has been flipping back and forth, being number 1 or number 2 for the highest median price home in the state. And if you're not aware of it, the area that it flips back and forth 1 and 2 is Midland for the highest median home price. But this year, Austin will be the highest median home price. San Antonio, similarly, coming back up again. We'll see probably greater than 4.5%. San Antonio is doing better than that on a year-to-date basis. These are projections. We've been hesitant to put these out, except just to talk about them. This is what we expected even without the pandemic, and so you can tell that even Austin and San Antonio are going to do well. Let me get you to the Four Rivers area. Here's what's going up here locally. Here's Comal County. All of you have access to this information. I know Four Rivers, the association puts it out on its website as well, but I thought I'd point it out. This is the third quarter, end of third quarter, and comparing it to end of third quarter of last year. Sale median prices are up 15%. I mean, Comal County is getting to be, quite frankly, an expensive county to live in. With a median price of $325,000. Closed sales up 40%. I mean, that's just phenomenal growth in sales in a month's inventory of 2.3 months. Extremely tight months, and it's less than that for the month of November, I can tell you. In Aggie speak, you ain't got none. So you got to watch out. Now, the number that draws your attention is active listings. That's what I'm talking about, the shortage of inventory, down almost a third. 33% would be down a third compared to last year. That's the reason those median prices are up so high. Let me draw your attention, though, to the price distribution chart. It's hard to tell and to compare it. But during the third quarter, almost 17% of the sales in Comal County were greater than $500,000, and that was only 11.5% of the sales of market share, if you will, of over 500,000 compared to last year. They're seeing this kind of we're seeing this kind of movement of distribution of sales around the state here especially the last 6 months, the last 2 quarters. A definitive shift in the sales in market share to the more expensive homes, the over $500,000 homes. It's still not the lion's share. You can tell here looking at the chart that something like 57% of the sales are between 200 to 400. But that shift to the upper end, that's one reason the median is a little higher. It's at 14.7. It's brought that median on up. Hayes County, very similar kind of thing. Median price up nearly 17%. Listings down 43%. I mean, almost half the number of listings, active listing in Hayes County. Sales are up a third. And that's the reason why the month's inventory, it's so low. I mean, when you're down under 2 months of inventory, again, in Aggie speak, you just ain't got any. And again, the 21%, over 20% of the sales, 1 in 5 sales, more than 1 in 5, over 500,000 in Hayes County. And historically, we've never really thought of Hayes County as being that expensive of a market, if you will. I mean, yeah, it's up there next to Austin, and Austin's high, but it's generally Austin, North Austin on into Williamson County where the prices are higher, but Hayes County is catching up considerably. But you still see that even in Hayes County, 43% of the sales were between 200 and 300, and 63% were 200 to 400. So it's still that sweet spot in there is 200 to 400. If you will, or 200 to 350 probably. But there is interest, and the shortage, the tightness in the market is leading to some of those houses that historically would have been in the 300s or into the 400s are now getting priced $20, $30, $40, $50,000 more than what they were just a year or two ago. Guadalupe County, which you also don't think of that much in terms of the price increases, is still showing a good increase in median price. Not as much. Active listings are down 31%, 30%. Sales are up nearly 20%. But you'll notice that market is even more heavily into the sweet spot where 62% of the sales are between $200,000 to $300,000. This is also, we're reading nationally, and we're getting anecdotal evidence, and you guys would be a great source of information for this. The pandemic effect, if you will, on the housing market is causing, or we think that it's causing people to want to move and willing to move a little further out, looking for a little bit more space. They're looking for more land. They're looking for maybe a little bit bigger houses, more square footage in the house. I mean, if you're going to be forced to be, sheltered in place and so forth, and you got 2 or 3 kids, you want some space. You want a backyard. You need to preserve your sanity. Also, because of people working remotely and so forth, the housing designs, the design of the housing space is changing as well. Builders are telling us people are looking for, they need maybe 2 offices if both the husband and wife are working from home. They really don't want to work in the same room, so give us some space. We also need space instead of using the dining room table as the school room. We need maybe a computer room or school room or something for the kids if they're going to have to do more in-home online education. So the demand for space, more space, people coming out of apartments in droves if they can, if they got the income, if they got the money, trying to get out of the apartment. I don't want to be cooped up in a 700 square foot apartment. And my alternative is maybe to go buy a small home, have a little more space, 1,500, 1,800 square feet, 2,000 square feet, whatever, and a yard and a way to walk around and not be in tight proximity with other people where I've got an increased risk of getting sick. Even in Guadalupe County, 3.5% of the sales over 500,000. My guess is that none of us think about Guadalupe County having homes in that price category and so forth, but yeah, and that's almost 3 times as many sales in that higher price bracket than what it was a year ago. So we're seeing those kind of things. Here's what it looks like spatially on the maps. This is the Four Rivers market area. This is Four Rivers north. This is the Hayes County, San Marcos and north side, if you will, Caldwell, Hayes counties. And I can tell you, there you are. I mean, closed sales in Caldwell and Hayes County and this part of the Four Rivers area were up 65 and 30% November over November. This is year over year sales increase that was referred to a little while ago. Prices, home prices doing the same thing. When it's in that green color, it means it's up over more than 11%. Well, it's up a lot more than 11%, both in terms of sales and in terms of price. And this is price per square foot, incidentally. This is not median. We think the price per square foot is a little bit more reflective of what home prices, home values are really doing, as opposed to being influenced as much by the distribution of sales. The same thing is true for the south part of the Four Rivers market area. You can see it's all dark green, light green. It's up in the different areas. This is by the zip codes within the areas, incidentally. So you can see that in both areas, Comal, Guadalupe County, 28, 72%. I mean, the sales pace is up phenomenally. You guys are, you've always been in, I talked about the sweet spot in terms of prices. You're now find yourself in the sweet spot between Austin and San Antonio up the I-35 corridor. If people are trying to the extent they are trying to get out of the urban core areas and move to more suburban, ex-urban areas, you're right in the path of where all of that activity is going and how it's trying to get there. Here's Comal County. Annual sales are up 18% on a year-to-date basis. This is year-to-date, so you're already ahead of last year significantly, even for the total year, and it doesn't include December yet, so it'll be even a little bit better than that. Median price is up considerably, up near $320,000, $323,000 I think it was. So you can see just exactly how Comal County, particularly Hayes County, doing somewhat the same thing. Hayes has not been as fast growing in terms of the the general annual levels of growth, particularly 15 to 19. A little bit slower rate of increase, but this year just taken off like a balloon, close to $300,000 median price. Year-to-date sales are up 21%. Like I said, you're really in there. Guadalupe County is the only county that was down a little bit. It was up November over November, but on a year-to-date basis, it's basically flat. I always count anything plus or minus 1% as being flat in terms of sales, but that's kind of interesting there. It won't show the kind of rate of growth you've had the last couple of years in Guadalupe County, but it's still coming back. The biggest problem in Guadalupe County, this is maybe more evident here, is the lack of inventory. Sales potentially could be even greater if there were just more homes available for sale. And this would include new homes as well as existing homes. And yes, there is a movement of new home construction into these counties by a lot of the home builders, but they still are concentrating a great deal in Comal and Hayes counties. Single family building permits in the area. The Austin building permit area, that Austin does come down and include Hayes County and so forth, are up over 12% year to date. We're going to see considerable home building construction going on in the Austin area. The same is true in San Antonio. It's up 12.3%. It was up 13, almost 14% last year. The home builders will tell you that they are active. They're trying to build. The home builders are running into some of the same kind of problems. They still have the issue of finding land for development at price that gets them into that sweet spot for new home construction. They also are having some upstream logistics issues. Lumber prices appliances, and so forth, and then labor. The construction labor market has been plagued by the coronavirus, just like a lot of others. Because it's the kind of labor that has to work closely together. One guy gets sick, everybody's got to get quarantined. Particularly the subcontractors getting their skilled workers and so forth, and to the volume that the GCs and the home builders would like to build, they're having trouble assembling the adequate labor force to literally build the homes. Anecdotally, I can tell you that we're being told by some of the builders, particularly some of the medium-sized builders, that their starts are going to be accelerated, but they're starting homes that basically they've already got contracts on. So it's not going to show up in new home sales. New home sales are treated differently than existing home sales. Existing home sales are by closure. New home sales are by when contracts are signed. So we're seeing that come into play here. So we do know that new home construction for the first half of the year, maybe the first 3 quarters of next year, is going to continue on the accelerated trend on that trend line because of the home builders having backlog needs to satisfy. And all of this is generating, it takes longer to build a house. Most of you who've been in the business for a number of years can remember when if you worked with a builder, you could get a new home built in 4, 5, 6 months. Well, today it's 8, 9, 10 months, and sometimes longer. So that time period also diminishes the overall numerical count of how many homes can be built and how many can be started in a year. Let me jump and say the 2 best words that you've ever heard an economist say in any speech is "in conclusion," because that means he's fixing to shut up. Here's what we think is going to go on, and I'll give you my best guess at some of this stuff. As you well know, we've had a lot of homes around the country and in the state of Texas in forbearance. I don't know if the forbearance in the Four Rivers area has been as significant as it has been in other areas of the state, particularly Houston, Dallas. But I suspect that there is some there nevertheless. I also know that a lot of homes that are with FHA and VA financing are judged to be a little higher at risk of foreclosure or forbearance because of the low loan to value ratio, the high loan to value ratio, the low equity, and so forth, and the way those work. So we do know that somewhere in the course of events in 2021, and when we get over some of these moratoriums on evictions and foreclosures that have been in place, I think that some of these are scheduled to go out of existence at the end of January, and it remains to be seen whether some of this would be extended on into maybe the end of the first quarter. But at some point in time, we are going to see a pickup. The delinquency rates have picked up. We can't go through with 500,000 people in the state unemployed or losing their jobs, because all of you know the number one reason for losing your house to foreclosure is lose your job, or one of the spouses lose the job and then the household is unable to keep up with the housing payments. And that's happening, and we're just going to have to see how that's going to work out. It's not going to be a repeat of the 2008, 9, 10 period when we had just a tsunami of foreclosures. It's going to be more limited to than that, mainly because right now the housing market is so strong that if for those people who are nervous or who may be now 6 or 7 or 8, 6, 7 months behind, or 7 or 8 months behind by say April or March or April or May of next year. And that's almost impossible to make up. You're going to either have to refinance and sort of regroup on the financing of the house with the lender. And a lot of that will happen. That'll be the outcome of some of the forbearance and so forth, is simply loans are going to be redone with higher monthly payments and recapture some of it and help both the borrower and the lender. The lenders are in just as much trouble. They got a problem because they probably have packaged the loans and sold them off in some securitized package. So we're going to have to do some of that, but then we'll get some more foreclosures. If you're nervous about foreclosure, maybe that'll help on the inventory of houses for sale. It might be a good strategy if you are a homeowner currently and can see the writing on the wall that you're headed toward foreclosure. Try and sell the house first, especially if you've got some equity in it. If the value is worth more than the loan, and a lot of homes now are, because the market's picked up, so it's not as many upside down lenders or borrowers as we've seen in the past. So we can avoid some of that problem. The moratorium, we don't know how that's going to happen. We've got a new administration that just officially got elected yesterday. I saw in this morning's paper where even Mitch McConnell has acknowledged the new president. So, I guess we got a new president. So we're going to have to see what they're going to do in the first 100 days and see if anything really changes significantly. Any kind of new regs, any kind of the extension of moratoriums, those kinds of things, and foreclosure forbearance, if you will. So we'll have to see. The low interest rates are going to continue no matter the administration. Those are going to continue. The monetary policy is not expected to change anything radically at all, if at all, for at least the next 6 to 9 months. So we'll see that. I mentioned it earlier that all of the business processes and procedures, the technology coming in has been really phenomenal. It's been accelerated. All of this was coming anyway. Most of you I know have been listening and paying attention to what's happening in the world and the market, especially in your industry. Be you a lender, be you a title company, be you a real estate broker, be a sales agent, whatever, inspectors. But all of that is changed, and it's accelerated and become more extreme here in our need, and necessity being the mother of invention. Here we are. We're moving down that road at a much faster rate, and it's not a bad thing. But you're going to have to adapt to it and learn it and so forth. Home construction and the housing market is going to be the prime motivator for the overall economy, particularly in the areas. Everything else is coming around too. Texas is having the advantage. We're still getting people and companies and businesses moving to Texas. It's going to create other kinds of problems. The energy industry is very nervous because we are going to probably go green sooner than later. Again, because of the pandemic to some extent, it's being forced on us. It's interesting. All of the major oil companies now refer to themselves as energy companies. They're getting in on it too. Exxon is spending billions of dollars on alternative energy, alternative fuels. It's nothing new. The changes are coming. For those of you who look like me with a lot of white hair and so forth, we always have trouble with change, but it's coming. It's inevitable. And we're going to have to deal with it. And home construction is going to be one of those prime recovery activities. The commercial real estate, there's going to be a major repricing in commercial real estate. The hotels, motel industry is going to be number one. Number two, right behind it's going to be the retail industry. The good news for the Four Rivers area, suburban retail, the smaller and more diverse and spread out retail won't get hit nearly as hard as some of the central end. The malls, for example, are all hurting very badly. We're going to see we're going to see businesses, the freestanding restaurants, the family-owned restaurants, the small establishments, the freestanding retail. We're going to go through a wave of those being closed down, going into bankruptcy, or changing hands. What we're looking for, and this is what I'm talking about, this acceleration of activity that's being forced on us from necessity. We're hopeful, and in Texas, we can see it happening already. The entrepreneurship and the entrepreneurial feeling and philosophy of coming out of starting a business, reopening a business, and so forth is coming. The big issue is going to be, are the banks and financial institutions be willing to finance new businesses and so forth without requiring an arm and a leg of equity and capital on the part of the entrepreneurs. Historically, that's when you've had the most entrepreneurial activity, is when financing is available, credit is available, business financing is available, lines of credit, et cetera, are available for businessmen to go out and open up their business, whatever the business is, and get it started and give it time to catch on and so forth. The office markets, for example, are up in the air right now. Longer term leases, a lot of the tenants are not necessarily out of business, but they've got their employees working at home. So they're still able to pay the rent, but when the lease comes up for renewal or something, all bets are off in terms of what's going to get negotiated and how it's going to get negotiated, so on. The warehouse industry and industrial space right now is the best of the real estate markets, but even there, we're keeping an eye on if we're going to get overbuilt in the warehouse sector and so forth. Some areas it's going to be spotty. There's going to be some overbuilding and so forth. Other areas it's not. Amazon has been building warehouse space and so forth. And it's not just Amazon. It's Walmart. It's Target. It's a lot of others. It's CVC. It's Walgreens. It's others that are doing this in addition to Amazon for distribution logistics space around the country. We haven't seen the value impacts yet. There hadn't been enough transaction volume going on to see exactly how all this is going to play out, the impact it's going to have on the local property tax rolls, particularly local property taxes that are dependent on commercial real estate values more than residential. The school districts in some of those areas are going to have to watch out and see what happens. But it's a little too soon. That's going to be some of the shaky areas in 2021 to keep our eyes on. I appreciate your attention here. I hope I have covered some of the points that you needed to know. And I do appreciate it very much to have been a part of your program here this morning. Katie, I'm back in your hands.
Dr. Gaines. All right. Thank you so much. We really appreciate you. We appreciate you sharing your insight. While all of y'all are on, we welcome your questions. If you would like to type your question in the chat box, if you have one, Lisa will be moderating those questions for Dr. Gaines. If you're available to stay on for a little bit, Dr. Gaines.
Sure.
And while we wait on you to type your questions from your notes, Dr. Gaines, we're going to ask to do a drawing. We would like you to choose a number between 1 and 73. And the first drawing is for a free GRI class. That's one class out of the 3 sessions that are required to get your GRI certification. And I believe that's a 3 or 4 day class, right, Regina? 4-day class. Okay. So Dr. Gaines, what's your number?
Yeah, 49.
Craig Pearson.
All right.
Right. Congratulations, Craig Pearson. The next drawing is for a $275 credit for Four Rivers Association of Realtors. And this can be used either for anything with Four Rivers, your dues, MLS, or education. Pick a number, Dr. Gaines.
32.
Warren Hoskinson.
Congratulations, Warren.
Great.
All right.
Katie, we just lost you.
Sorry. Okay, Lisa, any questions?
I'm not seeing any in the chat, but I had one.
Good.
For Dr. Gaines. You mentioned that the residential and the commercial are out of alignment right now, so the property taxes aren't going to line up. Do you think we'll see an increase in bonds for schools and infrastructure because of that?
No. Generally, it's reverse budgeting. The increase for bonds and schools and so forth is going to be based on the growth. So yes, that's going to happen, but not because of the change in the values. It's going to happen because you're going to have more kids and you're going to have more students. You can have more people. And all of that leads to, okay, we got to have more space. So we're going to need more schools. So the school bonding and so forth, it's a reverse budgeting for local things. You figure out what you need and then you go get it. It's not what do I have and then go spend it. I did see in the chat box somebody asking about the rural lands in Guadalupe County. The rural land market has been statewide has been kind of depressed a little bit. It's still going up, but it's not doing like what the residential market is doing. But my guess is that, and I don't know the county specific. I will tell you, go to Real Estate Center, recenter.tamu.edu, and look under data and look under rural land, and you can get information about what's going on down to the local county market as well. So my first answer to that question is there is a source of information from the Real Estate Center to help answer. My general feeling is that the land prices in Guadalupe County, if they haven't started going up yet, they're gonna, because it's that whole, you're close enough in, and particularly to the I-35 corridor between San Antonio and Austin, you couldn't throw a dart at a map and pick a better location to be in for rural land values to have the potential for increase. I'm not telling you that's going to be this year, next year, but it's coming. It's most definitely coming. There was another one that flashed up and I missed it.
They asked, how can we expect inflation in the coming years to affect prices and demand?
We don't expect inflation to be that predominant this year. It's still, despite the fact that home sale, that sales and personal consumption is going up and so forth, wages are not pushing inflation up. The only thing that's causing inflation right now is costs, for labor costs, material costs, distribution costs, warehouse costs, retail costs, and I'm talking about for goods and services across the board. So as a general statement, Lisa, and in answer to that question, we are not looking for inflation to play that big a role here in 2021, but look out for 2022 and 2023. If you start seeing the inflation statistics going up, for those of you who are data analysts and look at numbers, that's when interest rates are going to start going up. It'll also be when the cap rates start going up for commercial real estate, which is going to force commercial real estate values to go down. The values go in opposite direction with the cap rate. So that's something to pay close attention to. Won't be that big a factor for 2021, but by 2022, 2023, be watching out for it. Also, we generally get more inflation with Democratic administrations than Republican administrations. That's not a political statement. It's just track the history. But it
Dr.
takes
Gaines,
yes, ma'am.
we really appreciate you and the Texas A&M Real Estate Center. Tell us, what are you looking forward to most about your retirement?
Oh, that's a good question. I don't. I guess spending a little bit more time at home with my wife. I have for the last several years been traveling a lot, doing presentations and speeches. Actually, I enjoy coming over to New Braunfels and spending the night and being in the area. Great barbecue. So that's what I'll miss, but also it works both directions. I figure after 6 months, my wife will put me out on the road anyway.
Very good. Well, thank you so much for being here. Any other questions, Lisa?
I don't see any other questions.
Okay.
I do want to make sure that Dr. Gaines knows he has a special gift.
Yes, I'm aware. Thank you. Thank you very
Coming
much.
from the Four Rivers.
Thank you. I have to tell you, it got mailed to the office and I haven't been in the office in 4 months. But I'm going this afternoon. I'm going to go. They sent me a note saying, hey, we're holding this package down here. Come pick it up.
Good, I'm glad.
Regina, do you have anything, any housekeeping?
No, I think everybody's doing really well. I just want to wish everybody happy holidays and safe holidays. We'll see everybody, hopefully in person, if not in a Zoom format in 2021.
All right. Merry Christmas.